Welcome to the Wealth Webinar Wednesday. Today we are going through the infinite banking concept, the money multiplier method, and we're going to go right from how you can get started if you're brand new, you've never seen this concept, or maybe you're looking at a second and third policy, and just give you some really good ideas on how to start strategizing and building your infinite banking system. So before we get started, just have a quick 30-second video I'm going to play just to show you what we think about big banks and why you should become your own banker.
Get out of here. I'm not banking with you, not you, not you. Nope. Nope. I'm going to be my own bank. I'm not banking with you. Uninterrupted compound interest. Start your infinite banking policy today. Bye-bye, big banks.
All right. So one of the things we love to do at the Money Multiplier is have fun, and we're always putting together fun little videos and things like that. So today we're going to talk about what's going on in the world, what's going on with your money, what's going on with the future, and what opportunities you have. Because let me just start off with asking this question. How many of you are brand new to the infinite banking concept? Just write me in the box. If you're brand new, maybe you don't have a policy, you're just in the process of getting started right now, or maybe you really have no idea even what infinite banking and becoming your own banker is. All right, so we have a lot of new people on here today. That's awesome. Thanks for being here. So what we're going to do is I'm going to take you on a journey today, and I'm going to show you an over 200-year-old system that's used by some of the most wealthy and powerful people in the country to not only save, but also create, grow, and preserve wealth to create a legacy for you and your family, not only for you while you're living right now, but for generations to come. How many of you guys like the sound of that right there? Say yes. And that's exactly what I'm going to do today, is take you through that journey of exactly how you'll be able to do that. And I don't care if you are just getting by right now and you're piled and buried in debt, or if you're doing very, very well and you're very successful. This will work for every single one of you and everybody in between. As I mentioned, Shauna, who's one of our money mentors in the Money Multiplier team, is on here manning the chat box right now. And Shauna just got back from Disneyland in California, where she used her private bank to fund a trip for her and her daughter to fly out there and have an awesome time for a week. And guess what? She didn't have to pull the money out of envelopes that were buried underneath her mattress on her bed to be able to pay for that trip. She actually used her infinite banking private bank to be able to do that. And if you haven't seen that video, it's really cool. Go to Chris Naugle at the Chris Naugle on YouTube, and you can watch Shauna's video on that, but it's really neat. So for the rest of you, we're going to get into this right now. So one thing I know about the economy and opportunity out there is when there's blood in the streets, that's when millionaires can be made. And when you take back control of your money and you understand financial education, you're going to be able to set yourself up in the next decade or two to be able to be more successful than anybody else out there. I truly believe that more millionaires and billionaires will be created over the next decade out of any other time in our lifetimes. And it's the largest opportunity. But when is the time to be prepared for that? Now, right? You need to start getting educated and start getting prepared now to be able to set yourself up to take advantage of what's coming in the next year, 2, 3 years, and over the next decade, because more millionaires and billionaires will be created if you know what you're doing, you have a strategy, and you have a plan in place. And all of that starts right now here with me today. So I've been in the financial education industry for about 12 to 13 years now. I was a former financial advisor with Ameriprise Financial, but something, so I've had a lot of mentors over the years. I've had people teach me real estate investing. I've had people teach me entrepreneurship and how to start businesses, build businesses, sell businesses. I've done it all out there. And something I ran into a couple years ago now, it's been about a little over 2 years, was when I was first introduced to this man right here, Chris Naugle. And Chris Naugle became my new and #1 mentor. And Chris, if you don't know Chris, he's known as America's #1 money mentor. But when I first met Chris, something that I saw and he said was, it's never about your actual resources. It's about how resourceful you can be. And that's something that I've always thought and I've always taught in my own business and to my clients and my students, is it doesn't matter where you're starting right now today. If you have a desire and a will to do better, you can. I don't care who you are. Sometimes it's a little mindset shift. Sometimes it's learning something that you just never been taught before, but it doesn't matter where you are now. You can make yourself successful by taking advantage of strategies that we teach. And Chris, over the last 2 years, we've worked hand in hand every single day to spread the word on financial education and just build and, build and get the messaging out there for what I've found to be the most powerful financial tool and strategy in the infinite banking concept and the money multiplier. And my other, who's quickly become one of my other strongest mentors in my life right now is this gentleman right here, the founder of Money Multiplier, Brent Kessler. If it wasn't for Brent Kessler, Chris Naugle would have never gotten into infinite banking, and I would not be here where I am today as well. So these two gentlemen I owe everything to. So chrisnaugle.com, themoneymultiplier.com, and these guys are fabulous. All right. So I'm sure many of you, Chris and Brent, have been your mentors as well. And those of you that are new to our network, you'll learn more and more about Chris and Brent as you spend more and more time around our campfire that we have built. So something that I want to start out with is one of my favorite quotes, and this is something that Chris loves to say all the time. The problem in America isn't so much what people don't know, it's what people think they know that just ain't so. And if you just think about that for just a second, we're told our entire lives, to get an education, go get a job, work hard, advance in the company, put money away into a 401k, you'll have a pension plan, you'll have Social Security to live on later in life. We're told this stuff over and over and over again, and it's ingrained in our minds. And I realize this on a daily basis from questions that we get and comments that we get from people that are new to alternative investing and new to the infinite banking concept. They think they know everything. People think that they could go throw a bunch of money into crypto and become millionaires overnight. Maybe some people have done that, but my challenge to you is to keep it, right? That changes things a little bit. And so there's the right way, there's the wrong way, and there's everything in between. And the gray areas, that's a wonderful thing, because when you can combine those two things, that's when you can make some real magic happen. So just keep an open mind today, no matter where you are starting right now, keep an open mind. And I promise you, you will learn something new over the next hour or so. Just keep that in mind. And just to prove my point, let me show you guys something real, this right here. So if you take 100 people, right? You take a group of 100 people and you ask them, about their lives. On average, 5% of people are going to be successful, or at least in a position that they consider themselves successful people. And, out of the group we have on here right now, I can't see the actual number. It's probably around 150 people. Out of the 150 people we have on this live show right now, we had about 1,500 people, probably more than that. I'd have to ask Shauna exactly how many people registered, but it's always about 5% of the people that register actually take action and do something. So what you want to ask yourself today is, do you have an open mind? Are you willing to learn from what people have doing for over 200 years that are multimillionaires, multi-billionaires, and some of the most powerful financial institutions in this country are also doing? Are you open to open your mind and become part of that 5%? Because the Social Security Administration, they tell us out of 100 people, if you take 100 people at retirement age, only 5 of those people out of 100 are going to be financially secure. That means that out of 100 people, 95% are not going to be able to retire the way and the lifestyle and when they want to in retirement. Is that a problem? Absolutely. It's a huge problem. And if you can look at, if you're counting on Social Security, what's going on with that? I mean, Social Security is drained right now. It's about to go bankrupt. We're trying to keep it alive on life support right now. But, somebody like myself, my kids, we don't expect Social Security to be around when we're older. So we need to take back control and do something about that. We need to learn how, hey, what we've been told to do our whole lives might not be the best thing that we can actually be doing for ourselves and our families. And that's what this is all about. So why aren't more people successful? right? So that's a good question. So just put some things in there. Like if you've struggled or you've ran into any challenges in life, or you're not in a position where you want to be right now, why? What are some things that could hold you back? Just put them in the chat box and I'll show you some of the most common things that we found over the years. And those, are things like taxes, things like inflation, volatility of the markets. If you've been investing in a 401k and you're about to retire next year, you might be thinking your retirement looks awesome, right? We've been in a hell of a bull market over the last 10, 12, 14 years now since 2008 drop. We've just been going up and up and up and up. So everyone's retirement accounts and things are looking awesome right now. But what happens if we have a 40 to 60% market correction all of a sudden like that, and you're banking on that 401k retirement money to be able to fund your retirement, and all of a sudden that falls by 60%? Is it fair that your retirement was just cut in half? I don't think it's fair, but you did what you were told to do your entire life. How does that make sense, right? And it happens all the time. I bet you if you go to talk to people, if it's not somebody on here, go talk to somebody and they'll tell you, hey, I went through that, or I knew somebody that went through that in 2002, 2008, or I went through that during the dot-com bust, or whatever it was in the past, right? Somebody said procrastination on here. Absolutely. Procrastination is simply, hey, I'm really busy. It's Christmas right now. I'm pretty busy with the holidays and family stuff and work. I don't have time to do this right now. And then what happens? All of a sudden it's January and now it's the new year. And now you're busy with a whole nother thing. And then it's spring break and then it's summer with the kids. And then all of a sudden it's next December and you're watching this exact same thing, man. What if I would have taken action last year? So procrastination, I'm all in, whoever said that one right there. How about following the status quo? Right? Again, that goes back to the 95%, just doing what you've been told. How about fear? Has anybody feared doing something different than what you've been told to do? Fear is simply false evidence appearing real, right? The number one cause of fear is just lack of education and confidence. And that's where the power of mentors come in, of coaching. And speaking of coaching, those of you that stay on until the end today, I'm going to give you a couple links, a couple bonuses for being here. One of those bonuses is going to be a free coaching session with Chris and myself and our MSTV team. We do a coaching once a month with all of our members. And I want to give everybody on here that stays till the end a free session of that coaching, just so you can experience what it's like to have a mentor, to have a coach that's there to help you and understand this stuff. So you lose the fear and you have the confidence to start taking action. And then, life. And that's what I was talking about before with procrastination, or just things like, hey, I have this money, I've been wanting to invest it, but all of a sudden my car breaks down. And now I got to spend that money to, buy new tires, or to buy a new alternator, or to buy a new engine, or whatever the case might be. And all of a sudden, boom, your savings is gone that you're planning on using to start investing for your retirement. And just life happens, right? Divorce happens, sickness and illness, all the disasters, so much can go wrong in life. But guess what? These are what I always called excuses in the past. But here's the thing. They don't need to be excuses. I understand things can happen in life, but there's also ways to be prepared to handle those situations when they occur. If you're set up properly in life, I don't care what happens, you have a way to overcome that. And a lot of times take advantage of it. Okay. So example with inflation skyrocketing right now. Well, why not store your money in a place that's keeping up with inflation? Okay. Taxes are going up right now. And I'll talk about this in a minute, but stop putting your money into a place that's tax deferred, like a 401k, where you're just putting off paying taxes till later. Pay the taxes now, get that burden out of the way, and then create tax-free growth for the rest of your life. So there's things you can learn and strategy you can follow. Anybody on here can follow starting right now today to completely get rid of these excuses. And I don't want to hear them any bit more, but a lot of it does start with mindset. So there's a video, I'm not going to play it right now because we don't have time, but there's a video that's on YouTube. If you go on and you Google backwards bicycle, or go on YouTube and type in the backwards bicycle, it's a really neat video that just talks about mindset and how once we're taught something, how hard it is to unlearn it, or how hard it is to do something different than what's been ingrained in our life, ingrained in our minds in our entire lives. In the backwards bicycle video, it's simply a bicycle that's built backwards. So when you turn the handlebars one way, instead of the bike going the way you think it's going to go, it goes the opposite way. And it's hysterical to watch people trying to ride this backwards bicycle. And then if you watch it long enough, though, what they did is they took children that had not learned how to ride a bicycle yet, and they put those kids on this backwards bicycle. And guess what happened? Those kids were able to hop on and ride that bicycle like nothing to it, because that's the way they learned from the very beginning. So how many of you, let me ask you this question. How many of you would love to be able to teach your children financial strategies like this right here, that they will be able to learn the right way and take advantage of for the rest of their lives? You know, the number one thing I hear all day, every day, when I'm talking to clients and students on the phone is, I wish I would have known about this sooner. Why didn't somebody teach me this in my 20s? Why didn't I start doing this in my 30s? Why didn't I do this 20 years ago? I hear it every single day, because guess what? Once you have that mindset shift, and once you start understanding how banks work, how money works, what I'm going to teach you right now today, you're never going to be able to go back to the old way of looking at money, of looking at banking. You'll never go back. And you're going to say to yourself, man, I wish I would have got started with this years and years and years ago. So go watch that video. It's really powerful to start setting yourself up to have that mindset. So is this a new concept that I'm talking about? As I mentioned before, it's been being used for over 200 years. And there's a lot of people that talk about it. Maybe you just never realized it. But has anybody ever heard of that guy that had a rich dad and a poor dad, and he talked all about it? Yeah, his name's Robert Kiyosaki. Excellent mentor. Robert was actually one of my mentors back in 2010. 2009 to 2012, actually. I did several events with Robert. I spoke on the same stage with Robert. I took all of his trainings. Actually, I was just his partner that wrote all his books with him, Sharon Lecter. I was actually just at a mastermind with a couple months ago and had lunch with her and hung out with her all day in one evening. So, once you start developing these relationships, they're lifelong relationships. But in The Second Chance, in the book, The Second Chance, Robert Kiyosaki talks all about the infinite banking concept. How about Tony Robbins? You guys ever heard of Tony Robbins? Pretty powerful trainer when it comes to money and education, right? And mindset. Well, in the book, Money Mastery, the Game, Tony Robbins talks all about the infinite banking concept. Becoming Your Own Banker, R. Nelson Nash, one of the most powerful books that's out there right now. And this is basically like the Bible of everything that we do. And these are just, some of the books that we have on infinite banking. Of course, Chris and Brent wrote Mapping Out the Millionaire Mystery. And by the way, those of you that stay till the end, I'm going to give you a digital copy of Mapping Out the Millionaire Mystery for free. So make sure you stay till the end, and I'll give you the instruction on how to get that book completely for free. And of course, Chris wrote also the Private Money Guide, which is an awesome setup for the Private Money Club. And those of you looking to move money, do private money lending, or getting into real estate investing and need more money to pour on the fire. But there's a lot of good books out there. This is another really good one. Privatized, how privatized banking really works, with Carlos Lara and Robert Murphy. The And Asset, The Case for IBC. Profit First is a great business book. Building Your Warehouse of Wealth, another really powerful Nelson Nash book right there. Of course, this is the Bible I was just talking about on the screen. And those of you that registered today, Drifting Away from Traditional Car Buying, a great example. So those are excellent books to start with, to start learning and educating. And infinite banking is a concept, meaning it's not something you're going to learn overnight. It's not something you're going to learn the first month, the first year, even sometimes. It's something that's ever developing, and we're always teaching new strategies. We're always finding new ways to use our policies, new techniques to save on taxes, to use them with our businesses. So this is an ongoing. So start with these books, continue to learn, and we'll continue sharing what we're doing with our policies and how everything works. So in case I didn't introduce myself or you guys are new, my name is Stephen Nagy. I live down here in Jupiter, Florida, with my wife and my now 6-year-old son. That picture is a couple years old. This kid's growing like a weed. If any of you guys have young kids, you know what I'm talking about. But I've been doing entrepreneurial work. I've owned my own businesses, bought, sold, and run them for over 15 years now. Started out as a personal financial advisor with Ameriprise Financial. Had the Series 7, 66, 215 licenses, all that good stuff. Got introduced to real estate investing and entrepreneurship, let all my licenses go and never look back. Been in the business ever since. I absolutely love the coaching and training side. It's one of the reasons I became a financial advisor in the first place. I love sharing things that I'm doing. I love sharing powerful tools. And more importantly, I love helping other people change their lives. I came from a crazy background and I'm not going to get into it right now, but I went from one place where we were living on food stamps and had nothing to another place where we were on private yachts and private airplanes. And so I've seen both sides of the fence and I've been around it my entire life. And I'll just tell you, money doesn't buy happiness, but it's amazing how much more you can do when money's not an issue, how much less stress it causes, and how many more opportunities it opens up, not only for you and your family, but for other people as well. How much good you can do when you really have money. Because I don't know any broke people that are significantly making a big change in other people's lives through things like charities and through doing charitable work themselves. By having money and not having to work for your money, you have the time to be able to go out there and do that kind of thing. So what we do, and something I've built all of my businesses on over the last 15 years, is creating win-win situations. If I can find a way to help and have somebody else win, it will ultimately allow me to win as well. And that's what the money multiplier is all about. And I'll get to more of that a little bit later on as well. And as Sean is saying, money is your permission slip to be better and do better for the actual world. Absolutely love that, Shauna. You're 100% right. All right, so let's get into this 200-year-old system known as the infinite banking concept, and better known for us as the money multiplier. So to be able to understand money, first off, we need to kind of get rid of some of the mysteries and how money works. So just the basics. What is the definition of money? All right, a means of exchange, a means of trade, exchange of energy for goods, meaning exchange, a store of value, energy. All right, awesome. Yeah. So lots of answer, exchange for goods and services. Yeah, absolutely. So money is simply a means of exchange. I have this right here. I give it to you for this right here. And it's just a means to make the world go around, right? So that's all money is, plain and simple. There's nothing more to it. There's no reason to fear money. There's no worry to worry about money. It's just understanding that's all money is. So once we understand that, then we can ask ourselves, what is, how do we start growing money? So one of the most powerful ways to grow money is through something called compounding interest. Now, let me ask you guys this question. What businesses do you know that use compound interest? What businesses in this country use compound interest? All right, you guys are thinking. Do banks use compound interest? Nope. So those of you who said banks, nope, banks do not use compound interest. They charge you interest and they use fractional reserve banking, but they're not actually using compound interest themselves. I mean, if you wrote your name on a $20 bill, you went to the bank, you gave it to the teller, are they going to put that $20 bill in a box with your name on it? No, they're going to take that money and they're going to put it into motion, right? And there's not a business or a bank in this world that takes advantage of compounding interest. Well, let me ask this question. Are your dollars worth more today or in the future? Today, right? And I brought this up before. Taxes are always doing what? Taxes are always going up and up and up. So let me ask this. Those of you, that have traditional IRAs or 401ks, why are you taking your money, sticking it into those accounts, those IRAs and 401ks, where you're putting off paying the taxes till later? Can we all agree that taxes are going up and up and up and up and up every single year, it seems? Do any of you expect that taxes are going to go down in the future? So why do we continue to do that? Let me ask this. If you were to go out and buy a loaf of bread or buy a gallon of milk, would you stick that in your refrigerator and wait to eat or drink that? till next year? Or are you going to eat it now? Right? So it's real simple. Why are we giving up power of our money now? Why are we, if our money's worth more today, if I go buy a bottle of water today for $1 and I go buy that same bottle of water in 10 years, that water might be worth, I might have to pay $1.20 for that water. I mean, just think back, how much did a candy bar used to cost? How much was $1 of gasoline, right? So why are we putting off our purchasing power of our money now for later when the dollars are weaker and weaker and weaker? So we need to start being able to take advantage of our dollars now, but we need to be able to have those dollars compounding for us at all times. Do you guys like the way that sounds? All right, so let me show you how money flows. All right, so let me say this. Let's say you go and you buy a car. I'm just going to say it's a $25,000 car. I don't care. This is just an example, all right? So if you want to buy a Ferrari, just add a zero on there, make it 250,000, whatever. Just for this example, you're going to buy a $25,000 car. This is how money flows. All right. So let's assume that you have your money saved up at the local bank. Okay. So you have $25,000 saved up at your local bank, and I'll go ahead and play the local banker. Okay. So I'm banker Steven for this example. So you have $25,000 sitting in your bank account, and let's just say it's earning 4% interest. Now, does anybody know a bank that's going to pay you 4% interest annually on your money? No, it doesn't exist, right? And I think something just came out today that the average bank interest is 0.04% actually. But I'm just going to assume that I'm the best bank that's ever been in the United States today, and I'm willing to pay you 4% interest on your money. Okay. So you come to the bank and you come to me and you say, hey, Steven, I'm going to take my $25,000 out of the bank that's earning the 4%. And I'm going to go ahead and I'm going to use that $25,000 to buy a car cash. All right. So how many of you have ever bought a car cash before? Right? Car or cash, right? Cash. Have you ever bought a car cash before? All right. But if you go out there and you buy a car cash, what are you doing? I'm willing to pay you 4% interest on your money that's sitting in your bank, but you're taking that out to buy that car, right? So what are you doing? You're giving up the power of that $25,000 earning interest and growing. You're giving that up. You're throwing it out the window by buying that car, $25,000 cash. So what I say to you when you come to me to take the $25,000 out, opportunity cost, right? Is I say, listen, Shauna, instead of taking the $25,000 cash out, you're giving up opportunity cost, you're giving up the power of your money being able to grow and make more money. How about I continue to pay you 4% on your money? I'm going to use that account as collateral to give you this loan, and I'm going to give you a loan for $25,000 to buy that car. And I'm going to charge you 6% interest for 60 months to go out there and purchase that car. Okay. Would you guys be willing to do that? Just think it to yourself. Say, if I'm going to pay you 4%, but I'm going to charge you 6%, how many of you think that's a good deal? Write deal if you think that's a good deal. Or no, if you don't think it's a good deal. I'm paying you 4, but you're paying me 6. So aren't I making 2%? Let me show you guys how this works. So what if I could tell you that by you getting 4% on your money and paying 6, you actually make more money? How many of you guys think that that would be able to happen? And in this example, this is a 60-month loan, but it could be 3 years, 5 years, 6 years. It doesn't matter. The numbers are the same. But let me ask you, do you think it's possible to make 4%, pay 6%, but still make money? Let me show you. It does work, because what's going to happen, your monthly payment over the 6 months is going to be $483 to pay back that money at 6%. You guys can do the math. So your future value of that $25,000, once it's said and done, you've paid back into there $28,999. However, your money sitting over the bank making 2% less at 4% over that same 60-month time span has now grown to $30,525. So you've actually made $1,526 by earning 2 percentage points more or less than what you're paying in interest. And just to briefly explain why that works, it's compounding interest versus how a loan works. Because think about it, the 25%, each payment that you make is reducing that $25,000 amount that you owe, right? The $25,000 over here in your bank is growing at 4%. And each year that money compounds over and over and over again. So by making 4%, but paying 6%, you actually are able to make $1,500 by doing that exact same thing. And that is what the basis of what the money multiplier is all about. So let me explain what this means. The money multiplier method, it consists of the machine. It consists of the marathon. So the machine, we're going to look under the hood in just a minute. This is the vehicle that you're now going to use to keep your money flowing, to keep your money moving, and to keep your money compounding and making more money for you. Then part two is the marathon, okay? This concept, it's not a sprint. This is not get rich quick, but it's get rich. But it's going to take a few years for your new private bank, for your new business, you can look at it that way, to take off and start growing and become efficient. So this is a marathon, and this is something that's going to build for the rest of your life and for your kids' lives as well. And then we'll talk about what everybody's favorite topic is, and that's the millionaire. That's how to preserve, build that legacy, how to be able to live life on your terms and the way that you want to. So let's dig into this. What is the machine? Now, stick with me here if you've never seen this before, because I don't want you to just close out, because what the machine is it's a simple old dividend paying whole life insurance policy from a mutually owned insurance company. Yes, I'm talking about whole life insurance here that's going to be used as the vehicle. Now, this is not a whole life insurance policy that you can just call up your local broker or your broke-ass brother-in-law, as Brent likes to say, and get one of these types of policies. This is a specially designed and engineered policy built for the infinite banking policy, created by our team that has been doing this for well over a decade and are experts at building policies to achieve your goals for your personal situation. But at the end of the day, it is a simple old whole life insurance policy. Okay, so stick with me. The good news with that is whole life insurance policies have been around for a really, really, really long time. And the tax code that we work in around here has been around since 1930 or 1913, excuse me. So do you guys know, let me ask you a question. Do you know who the #1 purchasers of whole life insurance are in this country? The #1 purchasers of whole life insurance. Who is it? Yep. The rich and banks. Banks. All right. You guys are spot on. Banks are the #1 purchasers of whole life insurance in this country. It's something called BOLI, B-O-L-I. So what I want you to do is go out there and Google after this, Google BOLI, B-O-L-I, and you can read all about bank-owned life insurance. Why would banks, so let me ask you this question. When you walk into a bank, if you notice, almost everybody in the bank is a vice president, right? The reason why that is because by making that employee a key member of that business, it allows the business to have an insurable interest on that individual and allows them to buy an insurance policy on that individual. And that's why almost everybody at banks are vice presidents. So the bank can buy whole life policies on those people. Also, like we mentioned, the Rockefellers, the Vanderbilts, some of the richest and biggest names in this country use this strategy. If you look up Joe Biden, like when he was running for president, he released all of his records. I don't remember if it was this time he was running or one of the other 10 times he ran, but he released and it showed in there, he has several very large, significant whole life insurance policies. So it's used by some of the most powerful and rich names in the world, as well as the banks. And the banks are, you know, if you think about what banks do banks make a lot of money? And we're going to talk more about banks, because what we do and what we teach with the infinite banking is we mimic what banks do. We mimic what wealthy people do, and we do the exact same thing no matter what position that you're in. So just going back to what I was talking about before, do you guys now understand why we can make money earning 4% while paying 6%? And do you see why banks do this over and over and over again? All right, so let me show you how banks work and why. One of the reasons why, as much as I love banks, because we can take advantage of banks, we can use banks for leverage, we can use banks for cheap money when we need it, we can use banks to move money between our private bank and investments and opportunities. So I love banks when they're used the right way. But to understand how to use banks the right way, you need to understand how banks operate. So what banks do is, I'm just going to give you an example here. I'll stick with the 4% example. So you have, let's say, $100,000, and you take it down to your local bank and you deposit that $100,000 into your bank account. Well, does the bank just sit? Does that $100,000 just sit at the bank? No, they immediately take that $100,000 and they start moving that money. Remember, money in motion is always making more money, and banks understand that better than anybody. So take their $100,000 and they practice what's called fractional reserve banking, and they start lending money out all over the place. So, you know, you give them the $100,000, they start paying you 4% on that $100,000. But then let's say, hey, you need to purchase a home. So you go to the bank and you say, hey, bank, I need to buy a home. What do? They give you a home loan or a mortgage. Let's say they charge you 7%. Again, I know rates are different. You're really earning like 0.04%. You know, home loans are 3 to 4% right now. The numbers don't really matter, just giving you an example. And I'll show you how to get more specific with this in a minute. So what the bank does is they give you, you know, the money, they charge you 7%. You take that money, you give it to the seller. The seller typically is going to take that money and do what with it? Put it right back into the bank, right? Then the bank's going to take more money and they're going to lend it out. You know, let's say you need to buy a car. You go to the bank to get a car loan. They charge you 8% for that car loan. You go to the car dealer, you give them that money. The car dealer takes that money. The car dealer puts it right back in the bank. The bank, then let's say, you know, that home that you purchased a few years ago, now you need to do a remodel on it. You need to, you know, upgrade the kitchen and the bathrooms and put some new flooring in it. So you go to the bank and they charge you 9% for a remodel loan, a home improvement loan. You give that money to the contractors. The contractors go at the end of the job and deposit that money right back into the bank. And then you spent a little too much and you got yourself in a little bit of trouble and you got some debt. So you go to the bank and said, I need a debt consolidation loan. And the bank says, okay, well, we'll give you a debt consolidation loan at 12%. You take that money, you give it to the credit cards and whoever you owe money to, and they put it right back into a bank themselves. So what the bank was able to do with your $100,000 is they are paying you 4%. They made 7% on this loan. So they made a total of 3% on that first one. They took that money, they lent it out to the car. They made another 4%. They took that money, made another 5%. They took that money and they made another 8%. So out of those transactions, let me see, 7. So we're not even going to include the 12% they made right here. So stopping at the 12%, they made 20% during this transaction while they're paying you 4%. So how much more money did the bank make than what they paid you? How much more? They paid you 4%, they made 20%, right? How much did they make? What do you guys think? Moses says 400%. Okay. Is anybody thinking, well, if I take 20% that they made and the 4% they paid me, they made 16%. Anybody think 16%? 800%. All right. All right. Sal said 500%, and Sal is absolutely right, because they're paying us 4%, but they made 20%. So they made 5 times or 500% more on our money than what we were paid. And if you guys want to look into this and understand how banks truly work and what happens with banks and why we need to stop giving banks all of our money that just sits in there and how to start taking advantage of banks, banks are making between 400 and 1,300% on all the money that you leave there. Go to this website right here, BauerFinancial.com. BauerFinancial.com, and you can see exactly the money that these banks are making. But with that being known, is it any surprise that banks are everywhere? Think about the United States. There's bank branches every like 3 to 4 miles in major places, right? And in small towns, they're on every major intersection. Look in the major cities in this country. The largest buildings, the most beautiful buildings are banks. So if they're making 400 to 1,300% off of the money that you're leaving there, how about you stop leaving your money there? You guys like that? All right, so go to Bauer Financial and check that out. There's a reason why when you go to the bank, they give you those little lollipops that are sitting on the counter, right? What do they call those lollipops? Every bank in the country, what's the name on those? Dum-dums. Because you're dum-dums by taking your money and depositing at that bank over and over again. So start doing what the wealthy do. Start acting like a bank and become your own banker. So let's see how this works. So this is the annual pattern of spending. Again, you have to understand what's happening with your money and what's happening with the banks to understand how you can also do the same thing. So this is the annual pattern of spending for the large 95% of the population. So they say out of every single dollar, 20 cents of that dollar goes to your vehicle, whether it's a payment, whether it's gas, whether it's upkeep, whatever it might be, 20 cents of every dollar. 30 cents of every dollar goes to housing. 40 cents of every dollar goes to everything else, whether that's entertainment or food or travel or expenses, cell phones, things like that, right? So that means 90 cents of every dollar is going to other people and only 10 cents is going into our savings. Now, I will say this. That amount, 10% savings, has actually dropped pretty significantly. And actually, for a while there, we were in a negative savings where people were spending more. So this is actually being pretty conservative right here. But historically speaking, this is what the pattern of spending looks like. All right. However, when I was a financial advisor, one of the conversations I would have with people would be, hey, right now, this is the money that you're putting away. This is the expected returns that we can get. This is what this is going to look like at retirement age. You're not going to be able to retire at the age and lifestyle you want to with this pattern. So you're going to need to drastically change what this looks like. Meaning you need to cut back on what your housing expenses are, on how many times you're eating out every day, on how expensive your vehicles are. And you're going to need to start saving more money so that way we can build more money for the future. That was one of the things I hated about being a financial planner, was telling somebody that as hard as they've already worked in their entire life, it hasn't been good enough. What we're showing you here today can change your entire financial future by not working any harder, by not working any longer, and by not doing anything but changing where your money goes first. See, I'm not talking about what you're saving, but rather I'm talking about what you're spending. So what we want to do is we want to take some of the money that you're spending and move it into the savings category without changing your cash flow, losing control of your money, taking on any more risk, or changing anything else in your life. And that's what this is going to allow you to do. So let me show you this. Would this look better? So now let's look at what happened if you were to move all the interest you're currently paying to other people, but now you're going to take that and you're going to move that into your own savings. Let's see what this would look like. This is doing nothing else but changing where your money's going first. So on average, people spend 20 cents of every dollar they earn on their car. Okay. So 5 cents of that 20 cents is interest. That's on average. So 20 cents of every dollar spent on their vehicles, and 5 cents of that is spent on interest. Okay. So let's remove that 5 cents from the auto category, spending category, and let's move that over into the savings category. We've now increased your savings by doing that one thing by 50%. Okay. So let's talk interest. Even if you pay cash for your car, you take that $25,000 out of your bank at the car dealer now has your money. You've given up earning power of interest on that 25,000 by using that money for the car. You're either making one large payment or 25 smaller payments, monthly, but you are also gave up the interest you could have earned on that $25,000. Plus that money has gone, it's gone from your family forever. You've given it up for that car. You've given it to the car dealership. It's gone forever. So the opportunity cost is gone and it's gone from your future forever. So you're also going to have to save, got to continue saving, right, for that next car. Because let's face it, everybody loves a new car, right? So you're going to want to start saving up for that next one. All right, so moving on. People spend an average of 30 cents on housing, of which, believe it or not, 25 cents of that 30 cents per dollar is spent on interest, okay? Is spent on interest. So if you were to move that part into your savings, would you agree it's going to make a huge difference? See, many people say, well, my interest rates, what are you talking about? My interest rate's 3% or my interest rate's 4%. Or, hey, maybe I rent or whatever the case might be, right? But listen, when you own a home, go look at your mortgage statement. Did you know that 80% of your total interest you pay on that 30-year mortgage is paid in the first 7 years of that mortgage? 80% of the interest you pay on a 30-year mortgage is paid in the first 7 years. Do you know the average of how long somebody lives in a home before they ever sell that home or they refinance that home? The average in this country is 5 to 7 years. So 5 to 7 years is how long the average person is going to stay in a home before they either sell it and move to another one or they refinance it. And you're paying 80% of that interest within that first 7 years. So do you see where there might be a challenge there? And if you're renting, well, guess what? 100% of your money's going out the door, never to be seen again. So how about we take that and we stick that into savings? So I'm just trying to get you guys to think about, where's your money going? What is the average person doing? And how can we make these little changes to benefit from what we're already doing without changing anything else? So let me show you how to get back all the money. Of course, we have this, everything else. So we're going to take a portion of that. We're going to stick that into savings as well. So let me show you how we can start getting back all of the money for all the products and services you're already currently buying. And one of my favorite examples of showing you how this works in the real world is by showing you how to get all the money back for every car that you'll ever buy, drive, and own. And again, those of you that registered for this webinar, you got a digital copy of this, Drifting Away from Traditional Car Buying. And this lays it out in a little bit more detail, but I'm going to go over it right now with you today. In case anybody has any questions, we can answer those at the end. All right, so how many of you would like to get back every dollar from every car that you buy, drive, and own from this point forward in your life? I love cars. Anybody else car people on here? All right, so here we go. This is the machine. Let's take a look under the hood. Little play on words there, right? I like that. All right, so one of the things that we start doing when we start talking mindset and we opened up with changing the way that you think and things like that is you need to keep in mind when you open up a whole life policy, you're going to be putting premiums into the policy. Okay, this is money that's due. Now, a lot of people look at that as a bad thing. They look at it, oh, I got to put another $1,000 into my whole life policy this month. I just have this money coming out of it and it's going in there and, it's an obligation that I have. No. Here at the Money Multiplier, we call these deposits. These are not premiums. These are premium deposits. These deposits are going into your private banking system where they will be in your financial life and your kids' financial lives for the rest of your life. So I just need you to start thinking that way as I start getting into some of these different terms. Okay. Now, in this example, how old you are doesn't matter. What the death benefit on this policy is doesn't matter. So I'm going to ignore that stuff, but I'm going to simply concentrate on what we're doing with our deposits and how this policy is going to be used to get you back every dollar that you spend to buy that car, to drive that car, and to own that car. And just to keep in mind, this is just an example. I'm never going to tell you how much money you need to put into your bank, how much you're going to deposit into your bank. I don't care if it's $200 a month or $200,000 a month. This will work for you, and you will decide what that amount is. And we'll talk more about the specifics on that when we set up a strategy call. All right, so the premiums we're now going to look at as deposits. Again, the age doesn't matter, the death benefit's there, but it doesn't matter. So let's go ahead and take a look at how this thing works. All right, so this is going to be a policy that we have going for 7 years for this example. Now, a real policy, you're never going to want to stop depositing money into it after 7 years, and you're never really going to want to stop depositing money into it for the rest of your life. And I just saw somebody said volume is out. Can everybody else still hear me? Okay, you guys can still hear me. All right, perfect. All right, so for this example right here, let's just say that you're planning on buying a car in the next 3 years, okay? And you're gonna buy that $25,000 car. Again, I don't care what the numbers are, what the time span. This is just an example right here. If you want to buy a Ferrari doing the same model, just add a zero to everything, right? All right, so you put $10,000 into this policy for the next 7 years. Now, at year 3, you buy the car, okay? So what's going to happen is you put $10,000 in the policy in year 1, 10,000 into year 2, and 10,000 in year 3. And then in the 3rd year, you pull out $25,000 from the policy. And the way it works is you actually take a loan from the policy, and the policy is used as collateral. And that way your money's still in the policy growing and compounding for you. But nonetheless, you take that $25,000 from the policy, you go down to the car dealer, you give them the $25,000, and you drive home with that vehicle. All right. Then what you're going to do is you're going to pay $6,000 per year back to your bank with interest. Okay. Very important to be an honest banker, because if you were to go to that bank and you were to get that car loan, they're going to charge you interest. So if you're taking a loan from your own bank, do you want to charge yourself interest? Absolutely. It's called being an honest banker. And it's very, very important that you treat your money just like you would treat the bank's money. All right. So we're going to pay ourselves back with interest. So we're going to pay $500 per month for this car as a car payment, just going right back into our system. All right. So $6,000 is going in each year, for 5 years. So that's going to give us a total of $70,000 in deposits. Okay. Your car loan repayments, so another $30,000 has gone into the policy, because keep in mind, or back into your private bank, because keep in mind, you're paying yourself back just like you would give that money to the bank, except now it's building up in your own account. So now you have $100,000 built up in your private bank. Now you spent $25,000 of that $100,000 to buy that car. So you have a total of $75,000 now sitting in your private bank. Okay, you guys following me? However, you put $25,000 net into your private bank, and it's built a cash value of $67,881, which means we've now saved 91 cents of every dollar that you've invested has now come back to you from the purchase of that vehicle. However, follow me. What did I say a second ago? I said that I show you how to pay, how to get every single dollar back for every car that you'll ever buy, drive, and own in the future. Not just 91%, right? Not just 91%, 100%. So let me show you, because let me ask this question. After 5 years, what starts happening with a vehicle? It starts having some maintenance issues. You got to start replacing things on it. It kind of loses that new car smell. The new model comes around. There's a reason that these car companies develop new models. I mean, a Mustang is a Mustang is a Mustang, but nowadays they look like minivans, right? They're constantly changing the bodies of these things and how they look. And they all do that, and because they want you to go out and buy the new model, right? So, after 5 years, you're probably going to be bored, or you might want to get a new vehicle. So you go out there and you say, all right, I'm going to buy another car with my bank. Now, keep in mind, in this policy, for this example, just to keep things simple, we are putting no more deposits into our own bank. Now in your policy, in your bank, trust me, you're going to want to continue to put money into it because the cash on cash returns are unbelievable. And I'll show you that here in a few minutes. But for this example, we're not putting any more money in deposits into this thing, just to keep it simple. But in that 8th year, you go out and you buy that $25,000 car. Now, keep in mind, we didn't trade in this one. This one's still sitting in your driveway, getting back 91% of all the money, but we go out there and we buy another car. All right. And then we're going to do the exact same thing. We're going to be an honest banker. We're going to continue to pay for that car and continue to save up for the next one. So we're going to put $500 a month and pay ourselves back over the next 5 years to pay that thing off. So now we put no new deposits in. We have put a net injection of another $30,000 into our bank through the repayment of money to us, not giving interest to other people. That interest in everything is going directly to us in our banking system. So another $30,000 in. We bought the $25,000 car, which gives us a $5,000 a net injection into the policy. However, look at what we have right there, $23,592. So we paid in $30,000 into the policy. We took $25,000 out, leaving that $5,000 net injection. But the cash value of the policy has increased $67,881 at the end of year 7 to $91,473 at the end of year 12. So you've made $23,592 net on that policy, but you've really only put in $5,000. So now you have 2 vehicles sitting there in your driveway that have been paid for 100%. You still have all that cash value ready to buy the next policy, and you've been able to keep all that interest and all that money in your financial world, in your financial life, compounding, continuing year after year after year for the rest of your life. So when it comes to the machine, there's 3 rules that we just did right here that I need you guys to understand. Rule number 1, rule number 2, and rule number 3. And what are those? Rule number 1, pay yourself first. You've been trained to pay all your bills first, then take whatever's left over and put that into savings. But that's the wrong way of thinking about money. Paying yourself first means that you put money into your savings first, then pay your bills. So pay yourself first. Pay yourself with interest. If you have to pay the bank back with interest when you take a loan, you should be an honest banker and pay yourself back with interest to your own bank. You can't recapture interest if you don't deposit it into your bank. And then rule number 3, recycle and recapture your money. Would you agree that it's better to pay yourself interest than the bank? You'd get a lot more use out of that interest, wouldn't you? Absolutely. And if this works for a car, what else can it work for? I'm down here in South Florida. How do you guys think I'm going to buy my next boat? Brent Kessler flies around on a private airplane. His son's his private pilot, captain, and they fly all over to different events and different houses on their private plane. How do you think he bought that airplane? Exact same thing right here. What I just showed you to buy that car and get back every dollar for it is the exact same way that we buy everything in our lives. Shauna said she bought her daughter a go-kart using this. It can work for student loans. Just reading what people are saying. Yeah, golf cart, boat. Absolutely, Luke. So you guys are getting it. Yeah, debt. So Luke, thank you for bringing up debt, because that is the next thing that we're going to talk about, is how can you use this if you're in debt? How can this help you if you found yourself in a situation where you have some debt mounted, right? So let me give you an example of a doctor that had, how much was it? Not, where are we? I want to make sure I'm telling you the exact right numbers here. Okay, so the total debt for this doctor is $478,000, $774. His monthly payments are $5,777 per month, or $69,324 per year. This doctor, just to give you a background, 45 years old. He had 9 third-party debts that you can see on the screen. And what we designed for this doctor was a $25,000 a year annual policy. All right. So, so let me show you exactly what this will look like using the infinite banking concept to pay down this debt. Because if this doctor was just to continue doing what he was doing to pay this debt down, this $478,000 in debt, it would have taken him 19 years to pay this debt off. 19 years to pay this debt off. How many of you would like me to show you how you can pay this debt off in 7 years? That's what I'm going to do right now. 19 years. Let me show you how to do it in 7 years. And again, if your debt is lower, your debt is higher, this will work. It's the same concept. We just got to change the numbers around a little bit. So let me show you exactly how this works for debt. So in year one, this doctor deposited $25,000 into the policy. Okay, so using the cash value, so that immediate $25,000 injection in the policy gives him a cash value that he can loan against, that he can use, of $14,863. So he takes that $14,863 and he pays off the Discover card, the Lowe's card, and part of the Nordstrom card. Okay, so this takes the new debt to $463,911, and instead of paying $5,077 to the banks, he's now paying $5,329 to the banks. However, being an honest banker, you're going to take the payments you were paying to the bank, and now you're just going to pay them to yourself, to your bank instead. So the total amount that's now going to your bank is $448. So $5,300 going to the bank, like before, and $448 now going to your bank. So being an honest banker is very, very important right here. So what we're going to do in year two, another $25,000 goes into the policy with a cash value that year of $16,557. So because you're making payments into the policy that you're previously making to the banks, you also have $5,374, leaving you with a total of $21,945 of cash available in your policy. Because remember, we started paying ourselves back $448 a month, and that's now money that we have back into our bank because we're giving it to ourselves, not to the other bank. All right. So with this amount, we take that and we pay off the rest of the Nordstrom account, the Wells Fargo account, the private loan, and part of the BMW. So the total debt now is $378,000, and the new payment going to the bank is $3,860 with $1,917 now going to your bank instead. Remember, you're going to keep making payments to both banks. Okay. So in year three, after your deposit and the banking and the honest banking payments have been made, we now have $48,545 in cash value. So what we're going to do is we're going to take that $48,000 and we're going to pay off the BMW, and we're going to pay off the West Marine card. And then it's going to take our total debt to $283,000, with $2,100 of it going to traditional banks and $3,600 of it going back to our bank. And then, okay, so then if we take $25,000 for the first 3 years, we now have $75,000 in that policy, right? So remember, we put $25,000 in the first year, $25,000 in that second year, $25,000 in that third year. So how much money do we have in our policy? $75,000, right? However, keep in mind, we took loans. So the first year we took a loan of $14,000, the second year a loan of $16,000, the third year a loan of $25,000, for a total of $55,000 out of the policy. So this means we should have how much money sitting in our policy? What do you guys think? $20,000? All right. Again, you guys are thinking of the old way of banking and money. There we go, Andrew. Thank you. 75. You actually have $75,000 sitting in that policy, because remember, when we take those loans, we pull that money, that $55,000 of the $75,000 we put into the policy. When we pull that $55,000 out, we don't actually pull our money out. We're using that $75,000 as collateral against the $55,000. So the whole $75,000 is still in our policy, compounding and growing uninterrupted. It never stops. So that $75,000 is still in there, compounding and growing. All right, let's get back to year four now. So year four, we put you now have a total cash value. You put the 25,000 in. So we now have total cash value after all the loans and everything go in of $70,000. So we take that $70,000 and we put it towards the condo, reduces the condo balance down and the total to $187,000. And continue to note that the honest banker payment doesn't change on this one because we didn't actually pay the debt off. But we're going to continue. We paid it down some. So we're going to continue that year doing the same amounts. Then we get to year 5. Year 5, 25,000 goes in for a total of 71,000. So now we're able to pay that condo down and reduce the amount of the balance on the house. And we're also going to, we also eliminated that $879 condo payment. So now we have $1,221 going to the old school traditional banks, and $4,500 of it is now going to our bank. So now we get to year 6. In year 6, so what we do in year 6, and let me explain what we did on this one, okay? So in year 6, 25,000, what we did, we designed this policy where in year 6, the deposit amount went down to $10,000 for this example. And so one of the things that you have to be careful about when it comes to these policies is when we design them, like if you're putting $25,000 a year in, and all of a sudden you have more money that you want to put into that policy, you can't just put more money into that existing policy. So what happens is as your private bank starts to build the balance up and you're running out of room to put it into the policy because you're limited, there's rules that we work around as far as how the taxes work, how the IRS works. It's something called the MEC rules. And I'm not going to get into that right now on this, but it's how we design policies and what regulates them, what's called the MEC rule. So whenever we get to the point where we have more money sitting around than we're able to put into the policy, that's when you need to start opening up additional policies. Okay, does that make sense to everybody? And that's how you start building your banking system, is when you max out one policy, you open up another one and another one, because you can have as many policies on yourself as you want, as long as you qualify. You can start opening policies on other people's lives that you have an insurable interest in. And that's how you start building and growing your banking system. So in this example right here, we're only going to put $10,000 into the existing policy, which gives us a cash value of $13,000. And then we're opening up a new policy to start depositing another $25,000 into annually. And that new one, the first year, again, only has $14,863 in cash value. We still have our honest banker payments that go into it. So we now have $82,000 in cash that we can use. So is that amount enough to pay off the house? The house balance is $76,000 in year 6. Absolutely. So it gives us enough money to go ahead and pay that off, take our total amounts that we're giving to other people, to other banks, down to 0. And now all of the money that we're recycling and recapturing is now going back into our banking system and staying in our financial lives for the rest of our lives, right? And remember that you'll continue to make those payments into your policy like before. Now, how many of you guys liked how that doctor was able to pay off 19 years worth of debt in 7 years? How many of you would like to be able to do that yourselves? Well, one of the wonderful things about working with us in the Money Multiplier is we are going to do that work for you. We're not going to give you the money to do it, right? But we're going to give you the plan. We call it a debt map. So what we do as a company at the Money Multiplier all day, every day, is we do consultation and strategy calls. Our money mentors hop on the phone with you and they talk to you about your situation, how much annual deposits are going to go into your new banking policy, how that policy will be designed, for a higher cash value, a policy I'll show you in a minute, or a more traditional policy like you saw just now on that example. What works for you in your situation, what insurance company will work for you, what type of policy, things like that. So on that consultation call, we'll help you with that. We have an application team that's going to hold your hand through the approval process to get approved for the life insurance policy. But once you're approved and you start that policy, that's where our work really begins. Because what we have in place for you is a mapping team. And our mapping team is going to work with you ongoing into the future once you start your first policy to use that policy. So if you have debt that you're looking to pay down, we're going to create what's called a debt map. We're going to do a cash flow analysis with you to look at exactly what your situation is and how to use this policy to pay off your debt in the quickest and most efficient way possible. And you're going to meet with your mapping team and your mapping agent on a regular basis to update that map, to make sure that nothing's changed, to make sure that you're on track, and to help you use infinite banking. Because if there's one thing that we've learned over the many, many years of doing this now, is if we can teach somebody, if we can show them how to get started with infinite banking, and more importantly, if we can show them how to actually use infinite banking, they will never go back to looking at money and looking at banking the old way again for the rest of their lives. And they're going to tell other people about it. They're going to teach their kids about it. And that's a beautiful thing, is when you're able to do that. So our mapping team is a huge part. And you want to know the best part about this? There's no memberships. There's no fees. This is a completely free service that we offer all of our clients, from A to Z, from getting the policy going to helping you use it and ongoing support. We don't charge for any of that, okay? It's just part of being a Money Multiplier client. So get yourselves, if you don't already, that policy going, and we'll get this map going. Now, the reason the debt map's so important is what I've always called a financial GPS. And I've always been a huge believer in setting goals and having a plan. Because if I was to hop in my car right now and drive to Buffalo, New York, sure, I could do it. I just start driving north and keep taking roads that head north. Or I could hop in my car and open up Waze on a GPS. And if there's a car accident, it's going to route me around it. Or if a road is closed, it's going to tell me about it so I can get there in the quickest and most efficient and fastest way possible. And that's exactly what our mapping team does for you. It just helps you achieve your goals and dreams that much faster. And again, that's all part of what we do here every day. Now, this is where we talk a little bit about becoming the millionaire, protecting the millionaire, right? So let me ask you these questions. What if you don't have any bad debt? You know, a lot of people tell me, hey, you know what? I don't have any credit card debt. I don't have any student loans. I don't have any, I have a car payment and I have a mortgage and a second mortgage, but the interest rates are like 3%. Will this work for me? Absolutely. And I can show you an example. We're not gonna have time right now on how even at 2 or 3% interest, how this still makes all the sense in the world to do it through your own bank. However, it can also make sense to be able to use the money in another way to create more money to be able to pay those lower interest rates. So my opinion, take advantage of cheap money while it's out there and get your money moving in another way. But either way, it doesn't matter. What if you don't need a new car? Can I still benefit from privatized banking? Should I still become my own banker? And the answer is hell yes. And there's so many reasons. And what I want to show you right now is how that works. And this is really where the fun begins. Once you're out of the debt, you get rid of the stress in your life, you're ready to start having fun, building wealth, and creating that future for you that you can live and enjoy every single day of your life for the rest of your life. So how do we create wealth? Well, there's multiple ways to create wealth. And we basically do all of these using our policies. So if you are a real estate investor and you do flipping, how would you like to be, or even long-term holds, how would you like to be able to, instead of going to the bank to get a new construction loan, or to get a rehab loan, or to get a loan on a down payment to do a flip or something like that, and going through all the hoops and all the stuff that they require to do those types of loans, and they charge you the interest, and they have repayments and things like that. How would you like to be able to just borrow that money from your bank, pay your bank that interest? Oh, and by the way, when you borrow from your own bank, guess who's in charge of setting the terms for that loan? You are. So what I mean by that, you go to a bank, they're going to tell you, hey, you got to pay this loan back, $100,000 loan. You got to pay $900 a month. Principal and interest, $900 a month. You got to start repaying that thing. Well, when you get a loan from your own private bank, you're the banker. You're in complete charge of that thing. So you set the terms. So how and when, or even if you want to pay back that loan, completely up to you. So real estate investors, how would you like to be able to use the money and not have any of those holding costs, monthly holding costs of paying that money back? Wait till the end of the project and pay it all back in one lump sum. You can use this for commercial property, apartments, mobile home parks. Those are hot right now. I mean, affordable housing in this real estate market where residential real estate is just going bonkers. it's becoming unaffordable for a lot of people. So affordable housing, apartments, mobile home parks, these are great, 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 in my opinion, investments right now. So we're taking advantage of things like private funds. Even if you're not going out there and actively buying mobile home parks on yourself, get into a private fund that buys mobile home parks on your behalf and make 12% interest for doing nothing on your money. So private fund, private lending. This is why Chris and I started the Private Money Club. The Private Money Club is simply a place that borrowers and lenders meet, and lenders can lend their money to the borrowers, and borrowers can use the lender's money to be able to do more and more deals, and it creates these win-win situations. But what does all this stuff do right here? It's the movement of money. It's moving money. Remember, money moving is making more money. If you're a stock trader, if you trade crypto, if you do notes, if you're a business owner, think about the possibilities with this. If you're a business owner, if you can go and you need to buy a piece of equipment, but instead of going to the bank, you just take it right from your own private bank. All that interest now goes back. I'll give you one example as a business owner. And I'm not a CPA here at all. I'm just telling you something that I do that seems to work pretty good. But I'll take my personal policy. I'll take a loan from my personal policy. I'll create a promissory note and a contract, and I'll lend that money to my company. My company will then use that money for whatever it's using it for. And I'll usually charge myself, 6 to 8% interest. My company will pay back me. I'll make an arbitrage between what I'm paying for that loan to the insurance company and what my business is paying me. So I'm making a little bit of money, and my business then gets a nice tax deduction, either through the loan interest, or in some cases, depending on what you're using it for, in some cases, like equipment, a certain type of equipment, the whole purchase could be 100% tax deductible. So we're starting to save money on taxes using this. So business owners, that's one of my favorite uses for infinite banking, is with your businesses. And then we can get into key man policies and things like that too, but it's just amazing. So keep in mind, guys, when it comes to becoming a millionaire and having success, there's 2 laws for creating, growing wealth that are very, very important. Number 1, compounding interest. Any millionaire, any billionaire, any highly successful person I've ever met follows these 2 laws. Number 1, compounding interest. It's known as the 8th wonder of the world. Those who understand it use it. Those who don't, pay it. How about uninterrupted compounding interest for the rest of your life? Remember, that's $75,000 in that example we put in the policy. We took $55,000 out. There's not $20,000 in there compounding. That whole $75,000 is in there compounding uninterrupted for the rest of your life. Every dollar you put into that policy exponentially is growing, and never stops. So this policy solves that. Number 1 law. Number 2, you always have to have your money moving and flowing. Money sitting still is losing money. Money in motion is making more money. It's plain and simple. Money in motion is making more money. And this policy allows you to accomplish that as well. As the money goes into the policy, you pull that money right back out and you start investing. You start recycling and recapturing that lost interest. But it's still over here compounding and growing, uninterrupted, nonstop, always. And it's going to continue to grow no matter what happens with the stock market, no matter what happens with the economy. It doesn't matter. There's no outside influences. It's going to sit in there and it's going to grow and it's going to compound nonstop. And that's how you really become a successful, wealthy individual that lives a life on their terms. And again, money's not everything, but man, you can do a lot more when you have money. All right. So let me just give you one example of how this could be used for private money lending. Private money lending has become one of my favorite strategies. And for a lot of our students and clients as well in this environment, the stock market's very, very, very high. People are scared to go out there and, buy long-term holds and things like that. So they're getting involved with private money lending, quick flips, affordable housing projects, things that even if the economy turns, our money is protected and we're still going to be able to make money on those deals. So this is a policy that we recently created. This is just an example. Again, there's all different types of policies. You'll notice that this one is actually a bit of a higher cash value policy, right? Because the first year you'll see we put $150,000 into it and you immediately have a cash value of about $132,000. So a little bit higher percentage than what I showed you in that example earlier. And one of the reasons we're able to now create these very high cash value policies was thank you to the IRS rule changes that were implemented this year for the insurance companies. So there was an insurance rule called 7702, and it's now allowing us to put more money into policies with less death benefit, giving us higher cash value in the early years and stronger growth, which is exactly how we build banking policies. So it's almost like they roll back the rules to like the 80s when people were just going bonkers with these types of policies. It's like they rolled back those rules. So we're taking full advantage of it and building some unbelievable policies right now. So if you're thinking of your first, or you're thinking for additional policies and you have uses for that cash value right now for investing in things like that, let's chat about how we can build one of these higher cash values. One of the ways to do that is by doing what we call a one-time dump in, which you see this larger amount going in the first year compared to the following years. That's what we call a first year dump in. And that can a lot of times really jumpstart that compounding interest on that policy for you and the cash value that's in there. So in this example right here, they put 150,000 in the first year, 50,000 in for the first 7 years, and then it drops down to 48, and then 17,000 is going to continue to go in. So I just want to show you an example of this one. This was a 41-year-old female, I believe. Doesn't make a huge difference, but just wanted to give you guys that example. So let me show you guys this. This is how these things work. So they've been putting money into this policy and using the money right from day one. They've been taking it out. They've been investing it. They've been recycling, recapturing it back into the policy. So now they get into the 8th year of this policy. In the 8th year of this policy, they put $48,593 into it, and the cash value grew by $66,722. All right. So your private bank grew by $66,722 in the 8th year of this policy. To get that growth, we had to put a cash injection of $48,594 into the policy. So that was that annual deposit that year. So if you take 66,000 minus the 48,000, that gives us $18,000 in growth, or a $37,000 cash on cash return that year. And to do that math is very simple. Take 66,000 in growth, subtract it from the 48,000 that it took to get that growth, and then divide the $18,000 in profit that you made in your bank that year by the $48,000 that it took to get that money. And that gives us that 37% cash on cash return on their money. Now, what they did is they took this money along with a little bit of other cash value they had sitting there, and they took that and they did a loan. They did a private money loan at 12%. There's no points. This was just a straight 12% annual private money loan. Okay. So what they were able to do is by taking 12%, taking their money from their private bank and lending it at 12% on top of the 37% they made in the policy that year, subtracting the 5% we paid to the insurance company for the loan, that person made a 44% cash on cash return on their money that year by doing essentially little to no work. It took literally no work to put $48,000 into the policy that year. It took maybe a couple hours of work to evaluate that real estate deal that they lent the money on to make 12%. So they made 44% on their money that year. How many of you guys would like to start making 44% on your money without barely doing any work? And then what can you do with that profit? You can take that profit and you can create these private loans where they start paying you on a monthly basis. So what is that called? Passive income. How many of you would love to have money coming in on a monthly basis for doing little to no work while your money's sitting there compounding and growing for the future, and you have money that you're now living on? And if you make the numbers big enough, what's your lifestyle look like? Do you live on $5,000 a month? Do you live on $10,000 a month? Do you live on $20,000 a month? I just had a conversation with a guy last week that we're building a policy for him. He needs $500,000 a year in passive income. So we're creating a strategy right now to use this concept, using this exact policy exact type policy to create a plan for him that's going to pay him $500,000 a year in passive income that he can live on, because he wants to go out there. He's worked very hard in his life. And he wants to go out there and start enjoying it. He does a lot of snowmobiling and boating and flying, and he just wants to enjoy it. So we're creating that plan. So I don't care what position you're in right now, there's a plan and a strategy that can help you achieve those goals. So that's what privatized banking, that's what financial education is all about. And keep in mind, we did nothing in this example except where our money goes first and where our money is warehoused. Instead of putting it at the bank and then making those 400 to 1600% returns, we're warehousing it in our bank and we're making these unbelievable returns. Plain and simple. What would you rather make, 12% and let the bank do it, or 44%? That's the power of becoming your own banker. And keep in mind, we didn't even talk at all about today about the death benefit. The death benefit's big. You saw it on those policies. I mean, that's something that's going to pass down tax-free to your beneficiaries, to your family, to people important to you in life. Remember, the loans do not have to be repaid. I did mention that. The growth within the policy is tax-free. We're paying the taxes now, and then we're getting that tax-free growth, the tax-free loans, the tax-free death benefit being paid out. We're using our dollars now when they're the strongest. Policies are exempt in most cases, in most states, from judgments and liens. So your money's safe in there, safe and secure. And again, the uses for businesses are just unlimited. And that's one of the reasons why we do a lot of, mentors and masterminds and trainings to teach you strategies on how to use these for businesses and different uses. And I didn't even talk about kids policies. One of my favorite things is kids policies. I just started one for my 6-year-old. You should see what this thing looks like when he goes to college, when he's 25 years old and beyond. And not only is it something beautiful that he can take advantage of later on, but guess what I'm going to do? I'm going to teach him why I opened this for him, why he is going to become his own bank, and his financial education is it'll start now at 6 years old. So for those of you that say, I wish I would have learned about this sooner, I wish I would have learned about this 20 years ago. Do you have kids in your life? Do you have grandkids in your life? Do you have people you could share this stuff with? Let's talk, guys. Let's talk. So now do you see why I say, why aren't more people successful? These are just excuses. All we got to do is what the wealthy do what the banks do. It's your time. Warren Buffett said it best. If poor people would just do what rich people do, they wouldn't be poor any longer. And you got to ask yourself, I'm a big fan of pros and cons. If we live, are we better with or without this? Uninterrupted compounding interest, constant movement of money. And once we die, are we better off without this? Would you like to be able to leave that tax-free death benefit to the people important to you in your life? And if the answer is yes, are we better off on both of those? Then you guys better schedule that call very, very soon here. So Will Rogers, I'm gonna leave it with this quote just because it's one of my favorites. The problem in America isn't so much what people don't know, it's what people think they know. That just ain't so. I'm gonna shut down the share here, and I'm gonna start answering a few questions. All right, so Sarah said, I heard Guardian still offers 4% for the month is over. Need an agent that works Guardian. Can you give me a, yeah, Sarah, just give us a shout. So the 4% is an interesting question. And so what you're talking about is prior to the 7702 rule changes is there was a 4% guarantee that was offered on whole life policies. You have to remember the companies that we use are very, very strong financial insurance, mutually owned insurance companies. And over 120 some years of paying dividends, they've never missed a year, and they've never paid the minimum interest that was guaranteed on a policy. It's always a more. So right now, the guarantee is 2%, 3%, 4%. Does it matter? No, because our money is compounding in the policy between like 5.5% and 6%. So while it's nice for maybe like a smaller company or maybe like a new company or something like that, the companies we use have the highest ratings in the insurance industry. They're very, very strong and good at what they do. And they have the track record and the history of paying much higher dividends than what the minimum was guaranteed. And one of the benefits as well about the minimum being lowered right now is the loan interest rate is supposed to drop. So instead of paying 5% to the insurance company, we're going to be paying like maybe 3, 4, 4.5, whatever it is, but it's going down a little bit too. And also, like I mentioned earlier, the new policies are so much better right now for high early cash value, in my opinion, at least the ones that I've seen. So I don't know, let's have that conversation. But to me, this new rule change is unbelievably awesome. So what about the interest they charge you for giving the loan? Yeah, Ricardo, that's the 5% or whatever it's dropping to right now. And that's calculated into everything that we do. All of those illustrations, all of those examples, everything's calculated right into it. Because keep in mind, 4%, we're making 6% compounding interest versus simple interest. And really, you saw those cash on cash returns. In the 8th year, that cash on cash was, what I say, 34%. Well, guess what? The next year, it's like 45%. The next year, it's 60%. The next year, it's 80%. So, and it goes higher and higher every year for the rest of your life. So if you're making 80, 100, 150% returns annually on your money, are you worried about paying 4 or 5% to use that money? I would hope not. If you're worried about that, then you're not paying attention today, and we need to go back and start from the beginning. But that's pretty simple. And again, I don't know when these questions came in, so maybe I went over this stuff. So someone asked, I am paying premium each year when I borrow cash. My understanding was that we borrow against the policy, basically lending it from the insurance company. So I'm paying back. You mentioned paying ourselves. Yeah. So A-Deep. So the premium the recycle and recapture of interest you are giving to other people, we're now going to recycle and recapture back into our lives. And then as we recycle the money back into the policy, the 5% is going to be taken care of through the growth of the policy. So again, you guys just need to go back to the beginning of how this works. And yeah, Hannah's saying, if you have questions, make sure you put those in the Q&A, not the chat. We got about 5 more minutes of questions, and then I'm going to shut things down. But make sure you schedule those calls. This is all stuff we can talk about on the phone, on the strategy call with the Money Mentor team. And we do have an Ask Me Anything live podcast we're going to be doing at 4:30 Eastern. So you can always bring your questions there as well. Victor, no, we're not looking for more agents. But if this is something that you're practicing and doing and you're telling everybody about it, then maybe it makes sense for you to be involved in that side of the business as well. That's how Devin Burr, myself, Chris, even Brent, Brent Kessler had several policies before he started, the money multiplier. I have, so Moses, again, they're just saying, if I have a policy, I'm paying 5 and I can get money at 2%. Why would I do that? You just got to go back to, why are you giving anybody any interest when you can be using it? So go back to the basics, go rewatch another presentation, read some of these books I was talking about, and it'll start to click. Again, this is very common stuff. I want to make this clear. It's because it's a complete mind shift, boom, 180. It's a mind fuck, right? I'm not going to use bad language on here. That's what WTF is for, but it's a true mind F. Boom, when you finally get it. And it happens with everybody. Whether you've never, it seems to be, if you're a real estate investor, a business owner, it starts to click a little bit sooner. I think because you already have that kind of alternative way of looking at money and finances. If you've never been through any financial education before or learned anything about any of this stuff, it might take you a little bit longer, but I promise you it will click. And when it clicks, you'll never go back to asking these kinds of questions again. It happens all day, every way. I can promise you that. Direct recognition. Yeah. So we only use non-direct recognition companies for a reason. Again, that's all in a strategy call. What's right for you? What kind of policy, stuff like that. George said, do we work with Prime America? No. Prime America. They've been around for a long time. It's almost like, for those of you that don't know, almost like an MLM of financial advising companies, but they do a great job of bringing young people in and teaching them some basics of financial education, stocks, bonds, mutual funds, term insurance, AULs, things like different types of insurances, things like that. But something like infinite banking concept and what we do, especially design engineered policies, they're not going to be able to do that. I've talked to agents before. Where is the best whole life insurance and where to get it? Nestor, that's what we do, again, all day, every day. So schedule a call with us and we will definitely talk to you about how to set up your best policy with the best companies, and we will do all that for you. Will it work if you're not able to put 10,000 a year starting? Yeah, thanks for asking that again. What we typically recommend is 10 to 15 times your age on a monthly basis. So if you're 25 years old and you're just starting out and don't have a lot of extra money or anything, $250 to $300 a month going in would be a good starter policy. If you're 40 years old, maybe like $400 to $500 a month going in would be a good starter policy. So wherever you are, that's kind of what you want to look at. Another way to look at it is 10% of your gross income on an annual basis. So 10% of your gross income on an annual basis would be another way to go look at a good starter policy for you. But we can talk more about that on the Money Mentor strategy call. But you do not need 10,000 or anything like that. And you can just start putting in monthly, $3,600 a year policy, just start out at $300 a month. But I can promise you, if you're in your 20s, putting $300 a month into this thing, when you turn 35 years old, your financial future is going to look a lot better than if you just continue what you're doing now with your $300 a month, whatever that might be. I promise you that. Please explain. Yeah, I just talked a little bit about that, Sarah. Just book a call with me if you want to talk more about 7702. My number is 561-313-6213. I prefer you text me, especially if you're already a client. Otherwise, just book a call through the calendar, and that's usually the easiest way to get that scheduled. All right. And last question here, is there a cap on how much you can fund each account? Allison, there's not really a count. It's just what you can qualify for. So it depends on your financial situation, net worth, things like that. The insurance company's going to put a, what's your life worth type thing going. But typically we don't run into that problem. So what we do though, what you are maxed out on though, is if we build a policy for 10,000 a year or 25,000 a year, when you want to start putting more into that policy than what it's built for, then that's when you would want to start opening additional policies. When you max out that existing policy you already have, that's the time to start stacking them and opening up your branch offices and opening up additional policies. All right. So that's all the questions I see. Shauna, Hannah, how we doing? Everything great? I think we're 2:45 on the dot. So thank you everybody for being here. If you would like to talk with us any bit more, or you guys have any questions or need anything, please schedule a call with myself or somebody on our Money Mentor team. Again, this is all we do all day, every day, is strategize. What's the best company? What's the best type of policy? What's the best design for you? Let's talk about what works for your situation. We'll design this policy. We'll hold your hand through the application approval process, and our mapping team will start working with you to use that policy from day one all the way into the future. So thank you for being here, guys. Appreciate it.
All right, if you like that video, make sure you check out this video right now. And also don't forget, subscribe to my channel, and don't ever forget to smash that alert button. We'll see you on the next one.